Thanks everyone for coming back. I'm sorry we're running slightly behind schedule. But our next presentation and our next live session is, we are fortunate enough to be joined by the UK Prudential Regulatory Authority, who are going to be explaining, going through their climate risk framework at the UK PRA, and we're also going to be doing a group activity as well. This case study is actually stems from the CIF IIS application paper on the supervision of climate-related risks in the insurance sector. We will include a link to the paper in the chat box, and I really recommend participants, if you have an opportunity, to read this paper if you haven't already. So we are lucky enough today to be joined by Nicola Sinclair, Nick Dexter and Bridget Clifford from the UK PRA. So thank you very much for taking the time to join us today. And Nicola, I will hand over to you.
Thank you very much, and good morning, and thank you everybody for joining us today. I hope that you can all hear me clearly. It might seem odd for regulators to be talking about risks of climate change during a global pandemic, but our economy and financial system with the right support should eventually recover from COVID-19. In contrast, as you heard previously, climate change, if left unchecked, will lead to irreversible harm for generations to come. The PRA, as a CIF member, has been asked to prepare for you today a presentation that, as Pascal said, will present a case study on the supervisory expectations for insurers and how we respond to climate-related risks based on our own jurisdictional experience in the UK of how the supervisor has integrated climate-related risks into our own framework of regulatory day-to-day supervision. I'm going to be talking through the PRA's climate-related supervisory practices as a case study. The objective of this will be to apply theoretical concepts and ideas from the application paper that you will hopefully will have the opportunity to read through, and to facilitate you as supervisors to consider possible steps to integrate climate risk into supervision of your insurance sector. Later in the breakout rooms, we will ask you to complete a practical exercise with specific questions for about 45 minutes of discussion, and finally there'll be a presentation and discussion of participants' findings. So back in May earlier this year, IAIS published their application paper on climate risk. A huge amount of many people's time and invaluable input went into this. The UK's Prudential Regulatory Authority, the PRA, have set out supervisory expectations for its banks and its insurers on the management of financial risk from climate change. We've given a deadline for firms to embed these by the end of this year. PRA asked that insurers should develop scenario analysis and stress testing from climate change data. For example, future trends and catastrophe modelling. We've asked that insurers should develop quantitative and qualitative tools, for example, monitoring the potential impacts of physical risk factors on outsourcing arrangements and supply chains, and to define a credible plan to mitigate and manage exposures to financial risks from climate change. A number of companies have already made significant investments in resources and tools that they need to integrate climate risk into their business risk and investment decisions. We recognise that some organisations are still developing these capabilities, and it will take time. Firms need to manage these risks, not only as they materialise, but also looking over much longer time horizons than we're used to. They need to act strategically and preemptively well before consequences of inaction become clear. To embed supervision of climate change risk into supervision, the PRA will increase awareness to firms and educate and support the supervisors. Of all the building blocks required to effectively manage climate-related risks, climate disclosure is one of the most essential for transparency to facilitate the flow of capital towards investments that are consistent with an economy-wide transition to net zero. The financial sector has a crucial role to play. Better climate-related information is going to be needed. Given the urgency of climate threat to us all, a voluntary approach to climate-related financial disclosure may not be sufficient. As the central bank of the UK, the Bank of England is responsible for maintaining monetary and financial stability. This also includes supervision and regulation of banks, insurers, and financial market infrastructure. Bank of England supports international reporting standards for and mandatory disclosure of climate-related financial risks that are aligned with the Task Force for Climate-Related Financial Disclosures, TCFD framework. It's vital for the PRA regulated firms' safety and soundness that they're able to accurately identify, quantify, and manage climate-related financial risks. The PRA's work is focused on building resiliency into the risks from climate change into the financial system. That should enable it in turn to steward the real economy towards net zero in an orderly way. Being resilient means proactively managing climate-related risks and preemptively reducing them. The PRA started with a risk framework. Firms had needed to develop this risk-based approach due to Solvency II implementation in the UK. Back in April 2019, in order to encourage firms to incorporate climate change to their risk management, the PRA published a supervisory statement that was titled Enhancing Banks and Insurers' Approaches to Managing Financial Risk from Climate Change. It set out the PRA's expectations in 4 areas. The PRA expects a firm's board to understand and assess the financial risks from climate change that affect a firm and to be able to address and oversee these risks from the firm's overall business strategy and risk appetite. The more advanced firms have provided training for their board to enable them to oversee this risk appropriately. These firms have demonstrated the risks required throughout organisation have been identified, evaluated, and a plan made and resourced to close any such gaps. On risk management, the PRA wanted climate-related financial risks to be embedded in existing risk management frameworks in line with the board-approved risk appetite. More advanced firms are using scenarios to inform their businesses, develop understanding of climate risk, such as potential transmission channels, and to inform the integration of climate risk into risk management frameworks. The risk from climate change really can't be addressed properly unless there's adequate information. So we encourage firms to disclose exposures to climate risk and to look at how they propose to manage these. Most of the largest firms in the UK have started now to produce climate-related disclosures, and they are making improvements year on year. As a firm's risk management capabilities develop, they're able to complement qualitative information disclosed with quantitative information. Later in 2019, the PRA included climate-related scenarios in its insurance stress test. This exercise was entirely exploratory in nature. It was not focused on setting capital requirements, but it was instead designed to encourage firms to develop their analytical approaches to climate scenarios in preparation for future PRA exercises. This IST in 2019 was for many insurers in the UK the first time that they had conducted a climate exercise, and there were therefore a number of valuable learnings for both us at the PRA and the firms. The exercise highlighted key learnings for the PRA to inform the design, specification and reporting requirements for future climate exercises. The Climate Financial Risk Forum was established later in 2019 to build capacity, share best practice across regulators and industry. It brings together senior representatives from across the financial sector, including banks, insurers and asset managers. In June 2020, the CRFC produced a guide for industry covering risk management, scenario analysis, disclosure and innovation. The guide was designed to provide practical tools, knowledge and case studies which all firms can use to help develop their own approaches to managing climate risk. In July 2020, last summer, the Bank of England sent a letter to all UK regulated firms. It set out the bank's expectation that firms will fully embed climate-related supervisory practices into their management of risk by the end of 2021. The letter noted that climate change requires action now, even during the COVID-19 pandemic. While a few firms would have been on track for the timescale, the letter was intended to spur all firms into action. The letter covered examples of governance, scenario analysis, risk management and disclosure. The latest step was when the Bank of England launched its Climate Biennial Exploratory Scenarios, the CBES, in early June. This aims to assess the resilience of the largest UK banks and insurers against climate change. It covers both physical and transitional risk. Participants measure the impact of the CBES on their end of 2020 balance sheets. This represents a proxy for their current business models. This is the first time that we at the PRA are testing both banks and insurers to allow us to capture interactions between them and understand the risk presented by climate change across the financial system. We expect to learn through this exercise, which will help to inform future work on these risks. It's an important tool to size the financial exposures and to understand how different banks and insurance models will be affected and how they might respond. And finally, as a way of improving firms' risk management practices through the process of carrying out the exercise. Bank of England expects to publish the CBES results in May next year. The launch of CBES came after the Banque de France published the results of their first climate risk stress test in April 2021, and other central banks such as Canadian, Australian and European have also announced that they're planning to run some specific climate stress tests in their regions. This final slide summarises the key points that the UK Prudential Regulatory Authority recommends a supervisor to consider. In the UK, the PRA embedding climate-related financial risk into its own supervisory approach, while we're asking regulated insurers to embed climate-related financial risks into their business strategy through their own risk management frameworks. Where appropriate, a supervisor can ask about climate-related risk in meetings with stakeholders, such as climate-related SMFs, CEOs, board members. A supervisor can consider its firm's responses to climate risk to date. Some of a firm's response might be highlighted in annually published ORSA or board packs, in its strategy and planning documents, or within financial disclosures. Annual reviews can include a couple of sentences on the supervised firm's approach to managing and mitigating these climate risks. Within the PRA, we're encouraging supervisors to forward any climate-related responses of the regulated firm to the climate change specialism. This is clearly an evolving area of supervision for everyone in the industry, and we're all learning. And from there, I think we'll move to any Q&As that you might have on where we're at. Don't know whether Pascal wants to assist, if anyone's got any questions, if you want to type in a chat box.
If people want to type questions in the chat box, please go ahead. Otherwise, feel free to unmute yourselves. If easier, maybe we can come back to this. Oh, there's already Edwin, was that you? Okay, Edwin, go ahead.
Yes. Thank you, Nicole, for the presentation. I noted that you are working towards to have mandatory disclosure for major financial institutions before 2025. I just want to find out how is it going so far in terms of these disclosures. I mean, these mandatory disclosures. There are some institutions who are finding it hard to disclose these climate-related risks, or is something that is straightforward. Then my second question was in terms of the regulatory authority. What is it that you did to build the capacity within the PRA for you to be able to consult or manage this risk? I mean, these climate-related risks with the institutions. Thank you.
Nick, I'm looking at you.
Okay, thanks for that question. There's some good stuff there. I mean, disclosures are interesting because we at the Bank of England have undertaken their exercise ourselves, and as colleagues have said in various talks, have found that it is a lot more complex and time-consuming than you might initially thought. So we can talk from our own experience in doing those disclosures. We've got a number of companies in the UK market which have been involved with climate change for quite a few years, and a number of those have started disclosing some things. The difficulty is gathering the information needed to support full disclosure. So when you look across the piece, and there have been various reviews of the big UK insurance firms and what they have disclosed, and it is growing every year, both because you end up with different questions being asked by stakeholders of firms, different expectations being set by stakeholders, firms themselves developing the material and analysis they've got, and the depth to which they're going. So it's definitely a journey. I think we are as a UK supervisor and regulator are aiming to encourage firms to build on that work. So yeah, it is very much a multi-year exercise to get to whatever full disclosure is, which isn't obvious because I think the standards do keep changing. So yeah, that is certainly ongoing. And by the way, that includes both the narrower climate risk, but also the wider sustainability that is growing in importance. So hopefully that's covered that question. I'll let you come back to me in a moment if I haven't covered that properly. And I think the second question you asked was about our own resources. And that is, it's been growing in importance. I joined the bank back in 2014 and was involved in one of the early reports we did. Since then, it's been growing and growing, both in the different aspects of climate work that's been going on. So we've been both training people within the bank. We found that there are an awful lot of people in the bank who are naturally interested in this as a topic and therefore are doing their own research and building their own experience. And of course, because we've been pushing this as a core thing for the bank to be tackling, it has attracted people with experience in this into the bank as well. So it's a combination of training people and bringing in people as well, on certain aspects, because there's a whole range of skills that go into this, be it, understanding of meteorological issues, impacts on the economy, a whole raft of different skills that are needed, which doesn't come overnight. But I think that it's sort of, if you like, getting a seed planted for it to grow in starting somewhere. Is that okay, Edward?
Yes, I thank you very much. It's so clear. Yes, I just want to add one more question. Why are you only targeting major financial institutions? That's my final question.
To make it manageable, we recognise that to actually do this properly, I mean, if you access the CBES material, sorry, the CBES is aimed at the major insurers and banks. Our overall supervisory statement is for everyone, and we want everyone to apply it using proportionality to the risks and so on they face. CBES exercise is targeted at the major banks and insurers, mainly because it is. We recognise it's a very intensive exercise that unless you're a major bank or insurer, you won't have the resources to do it to the degree that we want it done. Now, we have got a number of volunteers, if you like, who are doing a shadow CBES. So we have talked to them about, they're not officially part of the main exercise, but they are wanting to do the analysis for their own good, and we're encouraging firms to do that. But to be honest, because of our own resource in analysing the material that we're going to get, to have too many firms involved would make it unmanageable, and we have to get the balance between having a large enough proportion of firms to make the results meaningful, but at the same time not creating an exercise which takes us several years to analyse. So we want to actually be able to give feedback on this quite quickly. So it really is trying to optimise that mix.
Okay, thank you, Nick.
Nick, if I may just come in off the back of that question, because we've had two questions in particular linked to Edwin's last question in the chat from our Tunisian colleagues. So how did the UK identify those major financial institutions, so the largest insurers and banks? And also, I think actually you've already answered this question, but what about the smaller insurers and banks? Were they involved too?
No, so it really was. We as in our normal regulatory activities have a grading system for which is related to the intensity of our supervisory efforts. So from category 1 down to category 5, and essentially on the banks we focused on the category 1 of banks, and I think on the insurers we've involved some of the category 2s as well, because there aren't so many category 1 insurers. But we've tried to get sort of a coverage of the market through that route. As I say, we've definitely encouraged other firms to be doing something along the same lines, but we recognise that to do the full exercise, as I say, is a very intensive exercise. Is by far the most intensive exercise we've undertaken, and particularly on the asset side, where we want firms to, rather than just look at broad categories of assets, so say stress oil firms buy this or manufacturers buy that. We're asking them to take something like the top 100 investments that they've got and analyse the risks that each of those assets are exposed to, and that is a huge amount of work on to do 100 assets in the level of detail we want. But we certainly encourage other firms to look at it and see what they can do, in the background, as it were.
Also a few more questions actually in the chat box, and actually I'd like to invite Mavalasi, because I know you had your hand up before. Are you in a position to unmute and ask the question, or do you want me to read it out?
Thanks, Pascal. Yes, I think my question was really wanting to understand from the presenters, in terms of the PRA, where are they in terms of the climate risk journey? Are there anything that they can be able to share with us, in terms of, the wins that they actually have, gained in the journey, and also what were the pitfalls that maybe we can learn from them as we also embark on the same journey?
It's a good question, and whenever I'm doing these sorts of talks, I always say that learn from our mistakes. Don't just follow blindly what we do, because there are all sorts of historical backgrounds to our approach on things. I mean, interestingly, one of the biggest challenges we had early on was answering the question, why is this important for the central bank? Now, we were lucky at the time that our governor was Mark Carney, who was a big advocate of this and obviously still is as the governor. And having him as taking as a personal interest in it and promoting it was a huge benefit. But there was still quite a few people who, when as a central bank you're looking at monetary policy, financial policy over a 3-year, 4-year time horizon, to say, well, why are we concerned about climate risks, which arguably are many years down the line and therefore outside of our normal time horizon? And hence there was this famous speech Mark Carney did around the tragedy of horizons, about which focusing on the fact that yes, the impacts are way down the track, but the activity we need to undertake is here and now, and that and hence there had to be there was a lot of discussions around the importance of this and why as a central bank we needed to get involved. So that was one big hurdle, and I think we had a big win with actually very quickly the Court of the Bank of England, which is effectively our board of directors, were right behind it, and certainly when the governor changed, the new governor took on the on it with equal vigor as the previous governor. So that was a big win. Then there was the obviously the challenge to the industry, and interesting, when we come on to the next session on terms of the workshops, we'll sort of try and explore this with you, is the why. There were a lot of companies saying, why do we need to be spending time on this? The non-life insurers were saying, well, we can reprice every year, so all this stuff is so far down the track, we can change the pricing. And they've gradually come to terms with the fact that actually there isn't infinite elasticity in pricing. You can't just reprice every year. The firms you're insuring's risk profile are changing, so you need to address that and so on. So that was the issue with the non-life insurers. But the life insurers, when they did their initial analysis on the impact of transition risk, it sort of had like a 1% impact on their assets. So they're saying, well, again, we can stomach a 1%. Loss of assets, that's not a problem, and gradually they've come to realise that actually it's not 1%, it's a lot more than that, because as was shown with COVID, the ripple impacts of some of these things are much greater than you often appreciate. And secondly, reputationally, we as a regulator want the insurers to take this on board, because the insurers and pension schemes are huge holders of assets and are greatly influential on the firms that they're investing in. So we wanted to promote this ripple effect of getting the insurers and pension funds as big investors to, encourage their firms to take action. And I think by and large, the firms have now are all on side on that. And certainly when we talk to boards, that's right. But it is that huge educational piece of getting everybody onto the same page of why this is such an important issue.
Thanks, Nick. We have two more questions if we have the time, actually. So one from Sharon Sikasanov, also from the South African Reserve Bank. How does the Bank of England monitor progress to get net zero emissions by 2050? Did you only ask banks and insurers to provide scenario analysis, or wider other financial institutions, other sectors, for example?
A good question. I think this is basically work in progress. I think metrics around this are really difficult. I don't think we've got the answer yet. I think we're working with the industry on this. Certainly as Nicola described earlier, we've been asking firms to embed this in their risk management, and as part of that, we're not saying to anybody, we've got the answer, because that we haven't. B, we don't want to impose anything, because there isn't a one-size-fits-all solution to this. What would monitor progress for one firm will be very different to another firm. So I think that we are sort of in the process of saying we want firms to get to the net zero emissions, but we also want them to devise how they're going to measure it. And then we will act as the facilitators in sharing good practice as good practice emerges. So I think this is, it's a really good question, but I don't think anybody's got the answer to this yet.
Thanks, Nick. And we have one final question in the chat from Tariro from Zimbabwe. The expectations possibly have an impact on the cost of providing insurance. How have you managed the cost issue, especially as we try to promote financial inclusion? And also the level of expertise in the governance structure. Was this an issue for you, the PRA, like for us, in developing economies You find expertise is low, which affects ability to implement some of the expectations. How do you address the issue or propose the issue may be addressed?
Wow, there's about 5 questions in there. Yes. So firstly, the cost of providing insurance, yes, this insurance gap is something that, you know, we talked about with, you know, within CIF, within the IAS. I'm a member of the International Actuarial Association, and we've been doing work on this protection gap is a big issue. The ATII has been over it, so everybody's aware of this. We've got a case study in the UK with flood insurance from a few years ago where it became the houses which were being regularly flooded and their insurance was becoming too expensive. And so there is the insurance industry has been working with government on a thing called Flood Re, where effectively to cap prices, firms can reinsure policies into a government-backed reinsurer to try and maintain kind of costs. So I think this is an issue for the insurance. The insurance industry needs to work with government, work with the regulators on identifying the issues and working out solutions. Again, it is a real challenge. I think the first point is to recognise that it's an issue, and then work out what the different solutions are. So I think that is a global issue, definitely. Expertise in governance structures. So again, Nicola touched on this, so that we've had for a while a requirement in terms of governance structures generally in the UK, which is on the back of Solvency II coming in. And the UK senior management regime applies to banks and insurers. And we've effectively said that this needs to slot into that governance structure. So one thing we've done, for example, we have said that each firm needs to nominate someone whose responsibility is to take the lead on managing climate risk within your firm, because we wanted a point of contact. And you will, I'm sure you will all know that the best way of getting action on something is having someone responsible for it, because they know it's in their job description, they know it's a regulatory responsibility, we know they're the go-to person. So we brought that in as part of SS 319 in 2019, and typically it's typically been the person responsible. It's typically been the CFO or the CRO. Sometimes it's someone else. Sometimes it's split responsibilities, and some you know, across that. But we felt it was important, part of the governance process, to have it as what we call a prescribed responsibility. You know, in the same way as money laundering or the chief actuary, chief underwriting officer, chief financial officer, we have to have a chief climate risk officer. So that's another key part of our process. On the training issue, you know, this is, you know, as we've touched on, we're all learning on this. We've been working with the industry on different efforts to provide training courses. Inevitably, the management consultancies are trying to get in this space. We've worked with the professional organisations like the Institute and Faculty of Actuaries in the UK, who are establishing a climate risk module within the actuarial framework, and so on. So I think this is and of course academia generally have picked this up as an issue. So the number of universities getting involved. So the problem in the UK is their training. It's actually coordinating the amount of training that's available, because everybody, there are lots of different institutions who are getting involved in this. And it just really is just trying to coordinate it and making sure that we encourage insurers to provide the right amounts of training. You know, it's sort of mandatory for boards to have training in these sorts of issues. So again, we're the enabler. The market is providing the resources, and we're just, you know, providing firms with the reason to get it done.
Thank you, Nick, for answering those questions. And actually, just to add, and just to reiterate as well, there is the CIF IIS application paper, which I mentioned at the beginning. And I would recommend that actually the paper gives quite a good outline on how different supervisory authorities, including the PRA, are approaching climate change. And I would definitely recommend that people, if they haven't read it already, to read it. I'll include a link in the chat now.
Yeah, absolutely. I'd second that. I mean, it certainly is. It's a very readable paper, and I'd certainly encourage anyone, as you say, to read that. And I'd also, for the technically minded, flag, and we can forward these. There's some a series of papers that we at the IAA, International Actuarial Association, are producing. So we've just issued our third paper in a series, which are aimed at actuaries, but are again quite readable papers. And Pascal, I can send you the links to those if you would like.
Yeah, that would be great, and we can share it in the chat as well. Nicola, if there's if there are no further questions, there are no further questions that have come in from the chat. So please go ahead. Back over to you. Thank you.
Okay. Thank you. So if we move now to the practical exercise for the training participants. So using the PRA's own climate-related supervisory practices as a case study, we would now like to present to you a practical exercise for all of the participants to consider. The objective of this practical exercise is to apply the theoretical concepts and the ideas from the IAIS application paper that Nick's mentioned, and hopefully everyone will have a chance to read now, and to help you as supervisors think about the possible steps to integrate climate risk into supervision of the insurance sector within your own jurisdictions. We're going to split out into 2 breakout groups with 2 discussion topics. The first group, I think Nick is going to take and lead, and this will be discussing for supervisors to assess the importance of climate risk to their own regulatory objectives. The second breakout group will be myself and my colleague Bridget, and the plan is to work towards identifying steps to a supervisory plan appropriate and proportionate to the impact of your objectives. So I think you'll be able to open up the PowerPoint, which will have your slides, have the questions like this and this. Hopefully everyone will be able to see that. Please, when you get into your breakout group, can you choose a spokesperson within your group who, at the end, will be able to come back and present the top 2 or 3 findings or themes from your group's discussions to the wider training participants when we come back. And I think, Pascal, you can correct me, I think we've got about half an hour.
Yeah,
and then we'll aim for presentations to be around 10 minutes from each of the 2 breakout groups. And hopefully we will then be on track for the coffee break at 11:50.
Thank you. And my colleague Rochelle is actually putting everybody into the breakout groups now. She's also included links to the templates, but we will also include links in the breakout rooms as well.